Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about how to trade using the stock scanner and option scanner. Matt, do you want to get us started by sharing your screen and going over our current positions?
Let's do it. All right. So we did an XSP. It was basically an iron condor. When the stock was 597, stock is lower now, so it's going to be a little bit of pain in that one. Actually, not too bad. It expires today, and actually we're up pretty good on that one. Earlier today, I checked it, and it was not looking as good. But so far, so good on that one. And then we had a GDX. What is this? Sell the 3136. Okay. So the GDX is... Got a lot of trades on here. I did a show. So we sold it for 9. We're up a penny in that one. So it looks like the 37 call we're short, but hopefully we got 5 days left on that. And then IBIT, we did a, what is that? We got a little bit of short there. So at 58, so IBIT, yeah, we're up large on that one. So we're making a good comeback. We've had a couple losing days, and we were on a huge win streak, Tyler, and now we're back on the win streak. So it's doing all right.
Yeah, that's how trading goes sometimes. But
Yeah.
we got good processes in place, and it's great. So this week, we get a lot of people, a lot of clients coming to ORATS and asking us, just where do I start? And what stocks do I choose? What are when do I enter? They're just having trouble getting started, and so a great place to start is in the stock scanner and signal builder, and you can basically look for stocks and backtest your signals, and get a good some sort of entry criteria going so that you can start trading through the dashboard. So why don't you get us started by going over the stock scanner, Matt?
Yeah, so I like to trade XSP. It's smaller than the SPX, so not as risky, but it's cash settled. So what that means is if you're trading SPY and expiration comes up and you have a position on, you could still get exercised on it up to an hour and a half after the close, and a lot happens afterwards. So XSP, not the case. It settles into cash right at 4 o'clock Eastern. So I like to trade that stock. And then I like to look at the Outlook tab, Tyler. So the Outlook tab is something that we curated to show some implied volatility relationships, and it takes a little while because there's a lot of data in there to load. But so basically what we see, and I'll turn on my screen share drawer. What we see is, when implied volatility is rising and finally nadering there, the stock usually is falling. And then, the opposite's true. When IV is falling, stock usually rises. Here, so we had vol hit a peak here and kind of come down to here, and it rallied pretty good. We had some kind of chop here, and then vol came all the way down, stock rallied, so you get the picture.
Right.
So what this is implied volatility divided by a 10-day moving average. We also have XSP, the 10-day moving average, but it's a ratio. of the implied volatility. You could think of it as the S&P divided by its weighted average implied volatilities of the components. And this is kind of a traditional financial dispersion correlation philosophy where a healthy market wants you to get as much benefit from dispersion as possible. So what that means is the individual averages of the components implied volatility can be very high, but if you take a dispersion of those, if you take an average of many of those, you should be able to lower the volatility of your portfolio. So that's kind of finance 101. And we can measure that at ORATS or using options by looking at the relationship between implied volatility and implied volatility average of the components. And basically what we see is when the market is having a tough time, that you hear things like correlations go to 1. What that means is the benefit of diversification goes down. And you'll see that by the implied volatility of the index going up towards the average of the components. Does that make sense so far, Tyler?
Yeah, it's just a way of comparing one stock versus a broader selection and kind of just is seeing the differences and using the ORATS indicators, like in this case implied volatility, but we also have slope and some other ones, and comparing them to see if there are any like discrepancies there.
That's true, but the difference here is that there's an underlying philosophy of the benefits of diversification. And when you lose that benefit of diversification, as we did, in this period in early August when the market just shut down, look at how high the ratio of the market implied went to the components. So that you lost kind of everything went down a certain percentage. And in that case, implied volatilities go towards the same, meaning the benefit that you got from using an index was very much reduced. But then,
interesting. Okay, so
yeah.
you're talking specifically about sort of noticing the patterns in implied volatility, specifically on sort of the benefits of an index. It could not really be as beneficial as you think in certain circumstances.
Yeah, in this circumstance, owning an index is you don't get the benefits of diversification. The reason that you own an index is that you lower your volatility, but in this case, when the markets fall, everything falls together, correlations go to 1, and there's no benefit. So that's not in itself the important thing. What the important thing is it also acts as an indicator, meaning when that's going up, that's bad for the market. When it's coming down and low, that's generally good for the market, although sometimes it gets really low and then you have to maybe fade that. But so if you look at this time period, we had a big rally all the way until recently, and that implied volatility was coming down at the same time, the relationship of implied volatility to the component weighted average. So that's just another indicator. This happens to be an inverse indicator. So when that's going down, it's good for the market. Same with implied volatility just on its own. When that goes down, it's good for the market. So that's just something to keep in mind. So what you might do is then set up a signal or set up a moving average of these, and you could follow that. Like if that wanted to be your bullish case. So like I'd want to, like for example, a bullish strategy might be selling a put spread, right? You wouldn't want to sell a put spread when the implied volatility versus the components is going up. You'd want to sell a put spread when the volatility versus the components is falling. And this is exactly what we see here, is that when it's falling, especially after the election here, that was quite good for the market. So that's what you want to see if you're trading like a short put spread or whatnot. So I bring that up because using charts and using, humans are good at visualization, and but there's so much data out there that you need. Then you could think of a overall strategy and then try to implement it using the tools. And obviously ORATS has a lot of tools, including backtesting tools. So for example, if we wanted to, we could go to our backtester, and then I'm going to get to the scanner later. But first I want to see if that's a valid thing to look at. I'll do SPY, even though I said not to do SPY, but SPY has more better markets for a longer period of time. And I want to do a bullish strategy, a short put spread. And we'll just take this stock one here. And another thing that we'll do is we'll kind of use intraday. So it enters every 5 days. That takes any path dependency out. And you could look at our other videos for what that means. But I'm mostly thinking about using an indicator here. So one indicator that I might use is we call it X earnings IV. So that's this ratio. So we want to see that the implied volatility is divided by its 10-day average is going down. So we want that like 1 as a max. Does that make sense so far?
Yeah. So is this related to what you were talking about with the indexes and comparing it to the components, or is this kind of?
I haven't done that yet. I'm going to do one strategy that this is the first graph. So this is just going to be this graph right here. We want to see this underneath the line, and that's 1. So as a matter of fact, we could check that out right now and see what it is right now, just to prove it out. Because so here's the stock scanner, and here is the IV. Let's just do that. Let's do a single. We won't do that.
Yeah, this is for the second graph. We're not quite there. We're into the first.
But you asked about it, so let's do that graph. My office buddy came in. All right, so we want to see the X earn implied ratio, and we want to see that display only. What is it now? So that ratio right now is high. Okay, so see at 124, Tyler.
Yeah. So that means that it's above the moving average. So if we look at the outlook, it should be reflected in there.
Yeah. Today the market went down quite a bit, and so we would expect that implied volatility to be on the upswing, and it is. So it's quite a bit above the moving average here. What we're saying right now.
One neat thing, if you go back to the stock scanner, Matt, you can actually click on the indicator in the table, that value, the 1.24, and it'll pop up a chart of the history of that indicator. So this works even if it's like a ratio or a
right. That's cool. Yeah. So so this is what we're saying, that this ratio is going up quite a bit. So that's a good point. So this wouldn't be a time when we want to trade this particular trade. So, anyway, so let's go back to our back test, and let's say, hey, we don't want to trade that if it goes 1. So right now it wouldn't trade that. So you'd say, okay. And you'd say, okay, there. The problem is that's just the entry, and it could find a lot of 1. So we also want to exit if it gets near there. So we want to exit if the same thing holds. So if the X earn implied volatility to 10-day, if that's, we could just set the same thing. So it'll exit this if this is false, it will exit.
Don't we want it to exit when it's going higher, like when the minimum's 1, or?
This is for a short put spread. So this is a bullish one. We want that the ratio of the implied volatility to be underneath the moving average. So we want volatility to be falling is really what we want.
Right, but then if it in the way you set it up, if it holds for one day, then it'll exit, right?
If it holds, no, if it doesn't meet that criteria, it will exit.
Okay.
It will stay in as long as, so you set the same. I always just set the same exit for the entry, and then it'll it'll do this. It'll perform the same way.
Got it. Okay.
So that's the back test, and this is the reason behind it. So this is, we have two things here. So we'll do the more complicated one after we do this one. So this is a short put spread, and then we'll do the same thing, the short put spread and SPY, but we'll use the more complicated one, and it's a little bit more difficult to set up, but I think we could do it. So we'll do it the same way. It'll take a little bit longer with these entry days, but we'll do it anyway. So now, Tyler, we're going to go in and we're going to say, well, let's do that same thing, that X earnings IV that we did before.
Mm-hmm.
But we're going to do that ratio, that relationship of that ratio. Actually, it's a little strange because this isn't exactly that, right? So it's kind of breaking this in two, but I think it might.
It's dividing just the implied volatility by the components. It's not looking at the moving average divided by the moving average.
Right. So we have a decision to make here. We could either say just the pure ratio of it over like 50%, or this kind of weird thing that I'm doing right now. So what I was going to do is that ratio, X earn of the SPY underscore C of the components. So,
well, let's just test them both out. Let's see how different they are.
Yeah. So I would think that, again, you'd want one to be your max.
Mm-hmm.
And then, okay. Then you want to exit when the same thing is true. And this is SPY underscore C. Same thing is true. Underscore C. Okay. Okay, so that's the first one, right? So we're good on that. The second one, we're just gonna do it over a certain percentage, right? So we're gonna go SPY, and we're gonna go that same short put spread, trade it every 5 days, and we're going to then say we want to get in when the X earn, when this, actually not the ratio here. It's just
not the ratio. I think we're just dividing just the X earn IV 10 day by the X earn IV 10 day of SPY C.
Right. You got me. And that's a max of 0.5. So we'll get in when it's 0.5 or less.
Why not 1?
Because this ratio is always going to be higher.
Okay. Right, because we're no longer comparing it to just a moving average. We're actually comparing the values themselves.
Right.
Yeah.
And you could see that
So you sort of just picked out 0.5 as sort of an arbitrary number there, right? Like it could be, you know,
Yeah.
0.4 or 0.6.
Well, I mean, when you look at the graph, I try to get it at places where I would do it.
Gotcha.
And it may seem like manual, but this is still doing a lot for us.
Mhm,
If
yeah.
you would have had to do this, like, back in the old days, when you had to do this by hand before our back tester. All right.
Yeah.
So, actually didn't change it too much by our thing so far. They're not that good of tests. Let's just take a look. All right. So let's see. It's in the market 63% of the time. The average holding period 7. So that looks good. I wonder why it didn't work out too good. So let's just take a look at these. Let's see, X earnings divided by the X earnings. I know that gets a little bit cramped in there. So that's what we wanted. So we did it. Yeah, it didn't do that good at the beginning, and lately it's been doing okay. Didn't do good in 2008. I wonder how that data is back then, but anyway, it's more of like I didn't look to see how these did before, but this is mostly how to come up with a thesis and then back test it. So this one's the 0.5 is slightly better, or it's better. Let's see what it's only in the market 24% of the time. It hangs out for nine days on average. So it didn't get a lot of these, but not that great. But again, it shows what you can do with. You could backtest this. So albeit a little bit complicated, but you could backtest your theories based on the graphs that we're looking at. So here's that 0.5, Tyler. I was saying I only want to be in that short put spread when it's underneath that.
Oh, got it. Underneath that sort
Yeah.
of horizontal line right there. Yeah.
Right. And when we do the ratio, you want that, like right now, you don't want to be in potentially, or when it's right, some people do when the ratio's rising, but when the ratios like that, you don't want to, this is a time when you might not want to be in this particular strategy. So now, I mean, like if you go to the stock scanner, you'll see those. So I type in XSP here. I could also paste a list in or whatever. And I have the 10-day ratio to the XSP. Then I put this one, I actually did this backwards, it looks like. So I'm going to take that out. So what we really want to see is that last one, the ratio to the X. So it's basically this one. I'm going to take these out. So we want to see that this ratio is under 0.5, and it's slightly over right now, is how we would kind of drive this particular strategy.
Mm-hmm.
And, again, right now, and you could then combine this with a scan. So we wouldn't want to do this right now, but, because this is a bearish strategy, but then you would combine this with a scan XSP, with a short put spread strategy in XSP. That would only trigger if so let's go do that. So let's do the 10-day ratio. So this is the 10-day average, and then we have automatically in here some ratios to the XSP. and we want to see that. That's 0.5. So there's nothing in here right now. So this is a bullish.
Yeah, I think what you're doing right now is basically turning the stock scan into a signal, right? And applying that to the option scanner so that, if that signal is meeting the criteria, then it'll find trades. If it's not, then it's not going to find any trades.
Right. So the bullish one won't find any. If it were the bearish one, then it finds that, and then it finds your thing. So you could use this essentially as your own signal builder in this. But this is now bearish. This is a bullish strategy. So, potentially we could do a bearish strategy that's that is maybe short a call spread. Probably want to, since this signal is pretty quick, you want it probably 2 weeks or even a week. And so, it would be something more like this. And I'd probably want to go more out of the money. So maybe we'll do this as our trade today, Tyler.
All right. Yeah. It's, there's a lot of stuff going on. Not the best back test, but I think the process is important to understand, right? Like the process of, finding a signal in the outlook or the signal builder, back testing that signal, and then applying that signal to the scanners to find the trade.
Right. So actually, let's do something a little bit longer term so we could have it expiring. Let's have it expire when we're on next week. So I think it's 8 days since. Is that right? Maybe 7 days.
Might have to go to 9.
9. Oh yeah, you're right. Yeah, the 21st. So we'll do this trade. Give them a couple cents. Force it.
Right. We did get a question, Matt, now that we're on the positions tab, about having a portfolio type of item added to the back tester. I think he wants to test the, back tests in the portfolio and see how they perform in the future, and if they're correlated to each other, or if they're that sort of thing. So to answer your question, Jeff, I think we are working on a trade journal that will help you sort of forward test your back tests. And then we're working on some additional stuff that'll just help you get started, picking back tests and testing them and seeing their impact on your paper trading portfolio. Do you have anything else to add to that, Matt?
No, I think that's good. Yeah, thanks for the question, Jeff. And if you want to email us or go into our community, you could ask more detailed question there. But that's what we got for today, Tyler. Our trades are looking good still, and hopefully next week we're looking all right too.
All right, great. Thanks, Matt, and thanks for the questions, guys. We'll be back again on Monday next week at the same time. If you guys have any questions, you can always ask us during the show, or you can email us at support@orats.com. We also have an extensive community tab, an online community where ORATS clients can share questions and thoughts on strategies. So please post there if you have any thoughts. But yeah, we'll be back again next week. Thank you, Matt.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.